Yeah, I'm Steve Milo, the CEO and founder of VTrips. We're the second largest property management in the U.S.
I'm Julie Brinkman. I'm the CEO of Beyond, and we're the global leader in short-term rental revenue management.
I'm Nick Abrahams. I'm the Chief Revenue Officer of NUMA. NUMA is an operator of 2,500 to 3,000 units across Europe, a bit like a Sonda or a Bob W or a Lima, which were mentioned in the previous session.
Thank you. Thank you to all of you. We've heard a little bit about growth and scale in that session just then. Steve, I'm interested because I believe your company did 5 acquisitions or something last year in 2022, so we can get us a bit more stuck into that. But how are you balancing organic growth and growth by acquisitions now?
Yeah, I think kind of what Henrik said in the last panel, right now the cost of equity and debt is just too high, right? So, and in the U.S. market, clearly we see that ADR and occupied nights came down, which means revenues come down. So we made a decision the earlier part of 2023 to focus on organic. And for people don't really understand what organic buzzword means, it's owner acquisition. It's acquiring owners using your internal resources. So instead of M&A, where you're acquiring someone else's portfolio, organic is basically going out with your staff and acquiring other properties. And we tripled the size of our staff over 2023 to do that, which was a pretty significant capital investment. We've seen people bring in about 1,600 units at the end of this year. So we've had good success on the organic side in the U.S. market. There's a lot of reasons for it, but it's an effective strategy. There's a cost to it, but and there's a lag of revenue. But in this market, or this right now where we're at, the only way we can grow revenue is through organic.
And Nick, similarly for you, I can explore a little bit. You operate in prime centre neighbourhoods and you're based out of Germany, founded 4 years ago, and you've also just very excitingly raised 59 million in Series C funding. So again, the same question, how are you balancing organic growth and acquiring assets as well?
Yeah, I think it's a pretty similar story to Steve, really. I mean, our growth, we made one very small acquisition in Barcelona 2-3 years ago for my time, but the rest of the growth has purely come from organic. And we have signed or put live another 1,500 units, I think, over the last 12 months. We plan to put live 2,500 to 3,000 next year. So our standard operating model is organic growth through expansion in our existing markets and expanding in new markets. Having said that, there is a lag, right? And we operate a mixture of takeover and development projects. Development projects are going to take anywhere from a year to 3 years to come live. So we are definitely looking at accelerating that, particularly in new markets that are particularly difficult to break into through some M&A activity. But there are somewhat limited options in our space.
But you operate, I think it's something like 4,500 units in 10 countries, and that's probably gone up again since I made the notes.
I think it's 4,500 signed, so okay. Currently live on the platform it's 2,700, 2,800, something like that.
So are you looking to sort of monetize your existing units better, or are you focusing now on like growth and scale?
I mean, I think everyone wants to monetize their existing units better. I mean, realistically, we operate quite a high occupancy model, so we're 85 to 90% occupancy levels pretty much all year round. Clearly, there's still room for some optimization from a RevPAR perspective, but you know, with the best will in the world, we can grow that by 10, 15%. The real growth in the business is going to come from bringing new units live. And the question for us is how can we accelerate that with the kind of units we want without having to see the quality drop or move into neighbourhoods that we don't think the product is quite so suitable for.
And Julie, with Beyond as well, you're a revenue management solution as well. So how are you sort of understanding the shifts in demand data, whether it's on the European side or whether it's on the US?
Yeah, so it's been really, obviously, we've seen so far this session, really interesting year in the United States and in Europe. You know, if you look at pre-pandemic, you could really understand what was going to happen by looking at history. And the pandemic really threw that into just complete disarray. So everything that we believed, that we understood, was no longer relevant and could no longer be applied. And so that really created the opportunity and the need to take a better stare at the data that we were seeing come in. So market data, connected data, what does pacing look like, what does occupancy look like? And that powered us through the pandemic and really into where I'm calling our next generation, where we are today. When you marry historic data with pacing data or occupancy-based data, it's not going to be enough to stay at the cutting edge. And so what we're focused on beyond is also contemplating and looking at intent-based data. So not only what's happened vis-a-vis a booking or vis-a-vis pacing, but what will happen. Where are people searching? What are they searching for? Really bringing your marketing team into your revenue management strategy, whether that's just through your ad spend strategy, but also being able to take that into your pricing strategy, and then how do you actually then execute that against your business development strategy, whether that's organic growth or M&A growth. We really think there's an opportunity to put intent data as sort of that third leg of the stool.
So what you're saying is like marketing and revenue management, they perhaps have been seen as separate before, but no longer?
I mean, I would argue that they're so inextricably linked. If your marketing teams are not working in concert with your revenue management teams, you have a great opportunity to really make that happen. Tying, you know, the marketers, they're the tip of the spear. They're seeing what's going on in the market, seeing what people are searching for, seeing what people are bidding on from an AdWords standpoint. And that should greatly impact your inventory. If people are searching hot tubs, I mean, we all know they're searching hot tubs. You want to talk to your owners about adding a hot tub. And so how do you connect all the dots and really start to make the most of each booking, especially in times like this where we do see demand sort of not pacing as well as we supply?
Yeah, so Paul, I mean, U.S. market, obviously, the numbers are much worse than Europe. And it really kind of exposed some of the challenges within the marketing team. And, you know, we inherited marketing teams through the M&A we did in 2021 and 2022. So what Jilly said is correct. We are e-commerce companies at the end of the day. You need people that have analytical and mathematical skills, who can read data. It can't just be a hunch. It can't be, well, this is how we've done things all the time. And so we've really restructured our marketing groups so that they're revenue groups. And the people with kind of soft skill sets are not going to be at VTrips. We need people who can analyze the data. We're a partner with Beyond Pricing. We're a partner with Key Data, and can understand how that factors in. And this is a really, really tricky market right now, because one of the things in the U.S. market, beyond all the things that Henrik just talked about, is the loss of learning, which has condensed the school calendars. So the ways that schools are trying to recover is by reducing summer break. So to add up all the other things, now you have a smaller summer break. So you need people who can literally read numbers, understand numbers, do segmentation, all the type of things that e-commerce companies do, that vacation rental companies have to do to be able to survive and outperform their competition.
And Steve, I think well, you already alluded to the fact that you're pivoting towards more organic growth as well now. How are you sort of able to manage and balance both the unit economics from a guest and a homeowner perspective?
Well, I mean, the thing with owner acquisition is, first of all, if it's just based on numbers, you're going to have bad results. So we bonus people based on revenue, and it's the only way. So in order to do this, you have to make sure it's not, that you're not bonusing it based on a flat level per unit. It's based on the revenue that unit's coming in. And that's how you're bonusing your sales team and the way it works. We have an internal team and an external team. So the internal team basically provides the leads. The external team is going out and closing it. In the market right now, again, one of the things that's been discussed is the inventory growth. That hurt many companies in the U.S. because it kind of eroded occupied nights and ADR because there was so much more units. But we are starting to see some of those rent by owners starting to ask for property managers to manage their properties due to the complexity of what's happened. The other thing, and I've talked about it on podcast, is Vacasa is hemorrhaging units in our market. So we have an opportunity, and we're doing it right now during the fall, to pick up those units as Vacasa hemorrhages units. My guess is at whatever point Vacasa finally figures out they're going to have to redo their strategy, they're going to close markets because they're in markets that make no sense for them. So there's a lot of units that are up for grabs, and if you have invested in an organic growth team, you can do it. And best of all, the cost of organic is 20% of the cost of M&A. So it's just, everything makes sense except for, it takes time. Because those units, even if you acquire them today, it takes time for the revenue to start to kick in.
And you, with VTrips, you got your first private equity investment two years ago, is that right? And at the time, I know that the sort of sense was that you were going to then deploy some money towards M&A. Do you think when market conditions start to improve, you might look to re-engage with M&A?
Yeah, no question. I mean, I think what M&A does is get you into markets. We got into markets we weren't in, and then you use organic to grow those markets. So I think it's not an either or, it's both. You use M&A to get into markets, and then you use organic to expand the scale of the market. The other question you said is, thankfully, we finished paying all our earnouts in 2023, so we are going to have excess free cash flow in 2024. And we will be strategic about bringing effectively distressed inventory. If I can be candid about what's happening in the U.S. market, there's going to be distressed inventory, and opportunistically, we're going to look to pick that up.
Nick, on the urban side as well, you're sort of balancing these mixed-use assets as well, and I know you've got like longer-term leases than say our other panels too. But how are you managing the unit economics when it comes to getting homeowners?
So we're primarily a fixed lease business. So from our perspective, the unit economics is largely around our side. We pay a rent to a property owner who has a 100-unit building, and it's up to us to essentially try to monetize that asset as best we can. We do have some management deals, but primarily fixed lease. I think the interesting one from our perspective is just trying to understand what the best use case mix is of those properties. So we are length of stay in the 3s, but we have a mixture of 1 nights up to 30 nights. And I think the kind of the really interesting piece that I spent a lot of my time thinking about is how do we price at a level that basically optimizes that inventory, and how do we do that in different times of year.
Yeah, and you talked about being smart, but how exactly, for our audience, how do you go about being smart?
I think, again, I'm somewhat new to the travel industry, and I was sort of surprised about how some of the pricing pieces worked, particularly when it comes to working with OTAs. In terms of how the rates are managed. So I think to some extent we don't quite have the freedom that we would like. But taking a simple example, looking at how we do 1 night stay pricing. So the model for businesses like ours is the costs are heavily related to cost per stay. And so traditionally, a lot of businesses haven't priced 1 night stays any differently to a 2 night stay or a 3 night stay. We've now started to implement some of these pieces, and trying to sort of be smart about what's the right level of discount for a 7 night stay and a 30 night stay. We'll be trying to take into account all of the cost factors, including how often are they going to contact our support team, how likely are they to be a repeat guest. We're trying to kind of factor all of those kind of things in terms of those pricing levers that we control.
Absolutely. And looking ahead into the next year, Julie, as well, how are you, what are you expecting in terms of the ADRs as well?
Yeah, so on the US side, we're looking at an occupancy year that we're expecting to be a bit better than next year. So while it's still early for both spring and summer, we are pacing a bit ahead of where we were in 2022, which is good news. I think what we'll see is property managers, what we saw in 2023 was property managers maybe held on to the ADRs that they received in 22 and 21 a little bit too long, and that hurt occupancy. I think we'll see an openness to considering ADRs, an ADR degradation from 23 into 24 in order to pick up occupancy. Not necessarily that it has to happen, otherwise you keep occupancy flat. But we're still up 30%, as Sally pointed out, from pre-pandemic on the ADR side. The trick is so are operating costs, right? And so, I don't know how much further ADRs can really fall without eating into property manager margins. So I think the other component to really think about is how do you manage your margin. On the European side, it's really the tail between the UK as well as like the Southern European markets. UK they've been challenged from a RevPAN standpoint since June of 2022. So all of the demand shifted sort of over to Spain, France, Italy, who have been growing as we saw pretty well. But we'll see those growth rates start to come down a bit. So if I were a European property manager with owners in Spain, France, or Italy, I would be having conversations right now about how next year is not going to look like this year, just getting ahead of those conversations.
So you're saying Europe being behind the US market at the moment in terms of demand? Are there any particular factors, do you think, behind that?
Well, I don't know about your Instagram, but every single person I follow ended up in Europe this summer. I don't know that that's going to be the case again this coming year. Obviously interest rates are extremely high both on the consumer and the business side. We're seeing oil prices start to skyrocket, which will affect airline prices. As Steve mentioned, the return to seasonal travel is there. The schools are back earlier. I'm not expecting that we'll see that demand continue to sustain on the European side. So I would say that next year will probably be flat over 23.
And the wild card is the currency exchange rates. Right now, the dollar is very strong against almost every foreign currency, which means it's advantageous to go from the U.S. to Europe, UK, not so much the other way. So I guess the wild card is the interest rates. If the U.S. banks flatten them and start to drop them, you're going to see the euro and the dollar start to come back to what's more of a normalized thing for like 15 years.
And on ADRs and occupied nights again, Steve, what are you kind of seeing, whether that's in the US or whether you're comparing that with other markets?
Yeah, so we had some tough conversations with the revenue management team about what we did right and what we did unfortunately wrong in 2023. And it's really tricky because it's not a let's drop ADR to drive occupancy. It's when you start to have compression and your summer break goes from 10 weeks to 8, you have to hold that ADR high and even higher and use rate rolls or booking rolls to maximize occupied nights. If you try to chase it by starting to reduce those booking rolls, you end up with a lot of orphan widowed nights, which wrecks your occupancy. So it's not so simple to just everything is drop ADR and we'll pick up occupied nights. You have to use the discipline of the booking rolls, which we've got a total buy-in from the marketing team and the revenue management team this year. So first quarter is looking better. We are a snowbird company, so we're based more in the southeast regions. The snowbirds look like they're fully committed to first quarter 2024. Easter falls opportunistically on March 31st, so the last week of March, even the third week of March are going to be very strong. So the first quarter is strong. Summer, it's too early to tell because we're going to hold on to the booking rolls to very late, which means we're going to be sweating it out as we go closer in. But I believe because of the compression, that's the right way to do it.
And Nick as well, how will you communicate with your own homeowners at NUMA about what to expect for revenue? Are you expecting to see those occupancy rates sort of stabilise, go up?
So yeah, remembering that most of ours are fixed leases, so ultimately the communication is only on the management deals that we have. Yes, although I don't think we're starting to see at a European level as yet. The data suggests that it's probably to come next year. We're not necessarily seeing any softening in the city centre markets. Now it's a mixed bag. I think we've seen, as you pointed out, Spain and Italy. We're not present in France. Rates have been great this year. RevPAR rates continue to be way up year on year when we look at both the STR market and we look at our own performance. Certain other markets, particularly more business-centric cities, have struggled a bit more. So Frankfurt is one of the markets we operate in, which I think is a tough market for anyone operating there. But we're yet to kind of really see it come through. I think the interesting one about our business is we're much shorter lead time. So our average lead time is only 20 to 25 days. So looking at what's coming next year, there's so little we expect to be on the books that we're not really seeing much signs of it yet.
Are you seeing any particular markets being in demand? Are you looking at staycations or international travel from a European perspective?
Yeah, I mean, we obviously saw some of the benefits of the US travelers coming inbound this year, but it's still the minority of our business. So, whilst the US would make up a low double-digit percentage, the vast majority of our customers were European, and so it'll be interesting to see how that impacts things next year. But I think we're primarily focused on European travel.
Is that something similar that you're seeing, Julie, or Steve, on the US side, perhaps? Like in terms of demand, which markets are performing most well at the moment?
I mean, drive too. I think 2024, if you have inventory that's in a strong drive-to market, I think you're in good shape, particularly if oil prices spike the way we all think they are and really affect airfare. So, and then that means, again, target with your PPC, you can geo-target. So you can be very effective with driving direct bookings through kind of that geo-targeting. But I think 2024 settles back into a year of a lot more drive-to destinations that are going to do well. The airfare destinations, I think, are going to suffer.
Is that something similar that you were saying?
Yeah, I mean, I think the key there is just really staying on top of the intent data. So what are people searching for? What are they curious about? What are they actually looking for? And making sure that you're super tight with not only your pricing, but also your organic growth strategy. Things like Taylor Swift concerts being announced and searches surging like 1,400% for Indianapolis. You don't want to miss those bookings in this type of market, because when you miss those bookings, you're going to piss an owner off, and when that happens, you're going to lose them to the growing property managers like VTrips, who are looking to pick up owners that are dissatisfied with their property managers. It's all about just staying ahead of that demand curve.
Yeah, and I think what happened in 21 and 2022 is so easy for demand that I think a lot of sloppy marketing started happening, and people went away from some of the things that are hard to do, like segmentation and discipline, geo-targeting, and even in some cases in the US market, people cut off some of the OTAs because their direct business was so strong. I think, again, those companies have really suffered that shut off those OTAs. And got away from that. So, learn from the US market, start to do all this stuff in Europe now, because it's coming. It's going to be softer in 2024. Hopefully in the US market we've stabilized, but when you're down 12% RevPAR, that's tough unless you have the ability to scale your operations down, which is not so easy.
And are you seeing any major differences between US and Europe when it comes to direct booking and booking channels?
Yes. It's pretty wild, actually. In the US, I mean, it depends on your market, obviously, but anywhere from 25 to 40% of bookings will come directly to your site. And that's not even accounting for what happens offline. So think phones, although millennials are allergic to phones. On Europe, on the European side, it just doesn't seem to be a part of the core revenue management strategy, which is such an opportunity. The reliance on OTAs in Europe is so high, and you're paying 18-20% right off the top. Forget about how much you're paying for any search results. So I think that there is a large opportunity in the European side to lean more heavily into the direct booking strategy and think about your business as an e-com business, because even those that deploy a direct booking website, well, the checkout is like 17 steps and a PDF fill, and and you have to insert your bank account information. It just isn't easy. So I think that is a very ripe opportunity for our European.
Yeah, use Google Analytics to look at your checkout. I mean, that's like the number one thing, and then have abandoned cart emails, all the type of stuff that, again, e-commerce companies do, US companies used to do in some cases. But, I mean, Our company did 60% direct and 40% OTAs because the lowest price is always on our website, always. And the OTAs squawk about it, but they still take our inventory even at a higher markup of 15, in some cases 25%, because that's the cost to cover the cost of booking or Expedia.
Nick, did you want to come in there?
No, I mean, I think coming from a US angle, the thing to know about Europe, particularly outside the UK, is just the dominance of Booking.com from an OTA perspective. So there's sort of the duopoly of Booking.com versus Expedia. When you look at Germany, the Netherlands, Italy, Spain, whilst it is a duopoly, it's so heavily skewed in Booking.com's favour. We are, absolutely a focus for me for the next year is to get the direct share higher. I think we have a relatively good website. We implement all those kind of pieces, but it's still difficult to break away from that Booking.com and Expedia reliance. Particularly, I think, when you look at the short lengths of stays.
Yeah, the U.S. market is a good cautionary tale about being too dependent on one OTA, because Vrbo was the big player in the U.S. market, and at least on the VTrips side, we've seen a 16% reduction on the Vrbo side. Fortunately, Booking.com has entered the U.S. market. They're starting to take significant market share. Key data showed 1 to 2%, but that's because so many of their clients don't even have access to Booking.com, and Booking.com is now starting to do integration with the property management systems. But learn from VRBO. These channels can cycle. And if you're too dependent on one channel, which some companies in the U.S. market are very dependent on Vrbo, it can be a bad situation.
Okay, thank you, everyone. Do we have any questions from the audience? Can't get to catch problems. Okay. Sorry.
Hi guys, I've heard a lot. Obviously, we talked about booking and EPS and that kind of ingress point, but not so much Google, especially when we're talking about direct and what they've done with Google Hotel Finder and now Google Vacation. I'd love to get your opinion on that.
Yeah, I mean, Google's been a huge, frustrating disappointment. I think if you can actually talk to people at Google, and that's hard to find because they've had so much turnover, they underestimated the vacation rental category. They thought it would be like the hotel category, and it's clearly not. There's been almost a complete 100% cycle of people there. It's still in beta. It's still on a PPC basis. Good luck, even a company as large as us, we were told 2 years to get our inventory direct, so we're using a channel manager. It is a mess. So the promise of Google is there, but I think we have them showing up at the VRMA. But I'd be curious to hear what their plan is, because we can't find someone to articulate their plan.
Any other questions?
Hi, so Francesco from Attido, property management company. Thanks a lot for the session, very informative. I would like just to understand your point of view a little bit more on strategy for direct booking, because what I'm doing from a corporate point of view is investing massively in the website, in strategies in order to grow our share of direct booking that I think last year was maybe 15% more than that. This year is definitely better. But as a booker, I very much dislike booking directly because I very find hard to trust brands that I don't know. So I know that if there's any issue with Booking.com or Airbnb, Expedia, I will be covered. They will just get down on their knees and find me a solution. While booking directly, I always know that if something happens, I need to be lucky with the booking with the operator that I book directly with. So my question is, how do you build that trust in order not to use only price as leverage, because maybe 10% is not something that can drive my, let's say, decision-making process as a booker?
I mean, it's a complicated question, but at the end of the day, it's the same issue as, do you buy insurance when you go to an airline or a travel site? You can pick up insurance. Usually the cost for that insurance doesn't make sense for most people, cruise, etc. In the U.S. market, we're clearly stating that on average they can save 20% if they book direct, is you create flexible deposit policies. You have cancellation policies that are pretty upfront, and we're very open about being able to move to another property another time of day. But at the end of the day, it's communicating to the customer over and over again that they're going to save a tremendous amount of money if they book direct. And it's working in the U.S. market. I can tell you it works. And you've got to put it in your emails. You've got to put it in correspondence to the consumer, even if they're using an OTA, how much they could have saved if they book direct. It makes a difference. That kind of money, 20% markup, makes a huge difference.
Yeah, and I 100% agree with what Steve's saying. I think the other way to think about it is that you can rely on OTAs to acquire that guest the first time, but you should not ever pay an OTA twice for the same guest. And so the thing to think about is, like, how do you optimize your booking experience for return guests? How are you collecting their information, showing them new properties and really building that loyal relationship with them? That, I think, helps address the trust question from a partner standpoint.
Okay, nice.
I was just going to echo what Julie said. I mean, I think for that first time, certainly what we see for that first time acquisition of the customer, I wish all the customers would come direct, but I do understand the mentality of saying a 10% price difference isn't enough for me to book direct, but it's unforgivable for the second and third time for them not to come through. You have that trust now, they know you're a legitimate company, you have the communication channel open. I think for us at least, we really need to boost that.
Collect their emails. Make sure you get their emails.